Welcome, welcome back to this channel. This is Unfiltered Forex with me, Clement, and in this video, we're going to talk about um, gold. All right. So essentially, there's an indicator I use on gold, which is basically the commitment of traders' reports, and it's usually very reliable to tell, or rather, to show you what's most likely to happen in the markets. Like, where is the money going to? Is the market, okay, is big money buying or selling gold? And which in turn usually always has an effect on price action. So before you start doubting and whatever, just start with an open mind, and then learn as you go. So essentially, like I said, going to be looking at commitment of trader report, and here we are. This is the CFTC website. All right, CFTC, as you can see, Commodity Futures Trading Commission. This is where this commitment of traders reports usually are released. All right, it's under market data and economic analysis. You can see commitment of traders. So yeah, introduction, classification, methodology, COT public reporting environment, types of report, long and short reports of format. Essentially, all the information is here. You can just read it for yourself. I'll just look at the definition in general. All right. So the Commodity Futures Trading Commission, the CFTC, zoom in here, publishes the commitment of traders reports to help the public understand market dynamics. Specifically, the COT reports provide a breakdown of each Tuesday's open interest for futures and options on futures markets in which 20 or more traders hold positions equal to or above the reporting levels established by the CFTC. So essentially, what this means is market participants are required to submit their position. Like you're supposed to state how you're positioning yourself and where you are. This is all for the sake of transparency, since their positions are usually very heavy and they do affect directions of commodities and currencies and even stocks. All right, so traders hold position equal to or above the reporting level. So you can see these are threshold for where your position size is supposed to be recorded with the COT, right? Nice. So, and it's about each Tuesdays. With these releases, usually they come out. They are released every Friday, but it's data up to Tuesday, like from Wednesday up to Tuesday. That's period, that 5-day trading period, because yeah, those are 5 trading days from Wednesday to Tuesday. But the data is released on Fridays. Okay, so the CFT releases the weekly COT reports in static format to support the historical usage patterns of industry professionals viewing and accessing each week's data. Each historical report is viewable with the data for respective reporting week, along with historical data compressed within an annual file. Yeah. All right. So with that, now the definition is mostly out of the way. The rest of this you can read it for yourself if you are that interested. So you can go to, yeah, public reporting environment. Not this one, not this one. Is not so useful. So there are types of reports, all right? There are 4 main reports. Legacy, supplemental, disaggregated. The legacy reports are broken down by exchange, all right? Legacy are broken down by exchange. These reports have futures only reports and a combined futures and options reports. Legacy reports break down reportable open interest positions into classifications: non-commercial and commercial traders. So these are the two main classifications you will find in the COT, in the legacy COT reports. Another one, supplemental. Supplemental reports includes 13 select agricultural commodity contracts or combined futures and options positions. Supplemental reports break down the reportable open interest positions into 3 trader classifications: non-commercial, commercial, and index traders. This is not This number 2 is not what we usually look at. Okay, so let's go to the third one. Disaggregated. The disaggregated reports are broken down by agriculture, petroleum products, natural gas and products, electricity, and metals and other physical contracts. These reports have futures only reports and a combined futures and options report. The disaggregated reports break down the reportable open interest positions into 4 classifications: producer, merchant, processor, user. That's one category. Swap dealers, manage money, and other reportables. So essentially, so far, yeah, there's also this other one. This is in financial contracts. This is not our focus of concern today. So there are two main types, if I would say: legacy and disaggregated. Why? Because legacy, this is where all positions usually are, like mm, positions on FX currencies, position on the stock market, position in crypto futures. Essentially, all futures contracts, you will find them under the legacy report, and they are broken down by exchange. For example, if you scroll down here, you can see legacy report, current legacy reports, and they are broken down by exchange. This is Chicago Board of Trade, Chicago Mercantile Exchange, Chicago Board of Options. So yeah, they are broken down by exchange. These are the legacy reports. And when you open a legacy report, what you will find is essentially financial contracts for all assets, all contracts traded, like especially currencies, more so, yeah, currencies and stock futures indices, bonds indices, they're also there. What else? What else? There's something I'm forgetting. Yeah, even crypto futures just recently got added. You'll also find them in the legacy reports. But remember, in this video, we're talking about gold, and just like it has been stated, gold is a metal and it's found under this category, disaggregated. If you go here, you won't find the positions for gold. No, you'll find them in the disaggregated report. And this report is broken down into 4 classifications with 3 main ones. There are only 3 main ones. These other reportables, you can ignore it. There are only 3 main categories here: producer, merchant, processor, user, swap dealers, and managed money. So you can see already, even just from the definition, there is a difference in what you are supposed to look at. If you look at the legacy report, the classification will be 2 main ones: non-commercial and commercial traders. But if you look at the disaggregated report, which is where metals such as gold usually are contained in, you will find 3 main categories: producer, merchant, processor, user, swap dealers, and managed money. As you can see here, just from the definition, the disaggregated reports are broken down by agriculture, petroleum, natural gas. These reports have a futures only report and a combined futures options report, because these are physical contracts. All right, these are contracts linked to an actual physical underlying asset, right? Like agriculture, if we talk about soybeans are real, they are tradable, and yeah, exports and imports, soybeans are there. Petroleum products, oil and natural gas, and which other one? Yeah, let's talk about oil and natural gas and petroleum and its products. Yeah, natural gas and products, electricity and metals, silver, copper, gold, palladium, aluminium, all metals. They have futures contracts and they are reported here in the disaggregated report. All right, so now that we are done with the definitions, you can go to the formats: short and long formats of reports. Legacy and disaggregated reports are available in both long and short format. The TFF report is only available in the long format. The supplementary report is only available in the short format. So the short format shows reportable open interest and week-to-week open interest changes separately by reportable and non-reportable positions. For reportable positions, additional data is provided for commercial and non-commercials. Holdings spreading in certain categories only, changes from previous reports, blah blah blah. Yeah, essentially that's the difference. short and long format. The long format, of course, is more detailed. The short format is mostly a summary. So as you can see here, the website just classify them really very well, because you don't have to scroll. If you are focusing on gold, all right, don't scroll down even, because this is the first thing you'll see when you open this page. Metals and other. Disaggregated futures only. Yeah, metals and other. Don't go to futures and options combined. No, just stick to disaggregated futures only. This is where you'll find gold, metals, and other. Long format or short formats? Let's pick short format. Right. So this is how the CoT report is looks like. Yeah. Forgive me for okay. No, forgive me. It's not my mistake. So this is as rugged as it seems. Yeah, this is actually how they report it. This is the official data from the official website, and this is how the reporting is done. All right. Why? Because yeah, they prefer to keep this classic style of doing things. So yeah, now let's look at them directly. Palladium, this is palladium. Don't look at that. Platinum, no. We are looking for gold. This is silver, and finally this is gold. Gold Commodity Exchange Incorporated, contracts of 100 troy ounces. So as you can see, let me pick this one. Yeah, there's a producer, merchant, processor, user, long, short. You can see they are divided quite well. There's also swap dealers, managed money, and other reportables. The 4 categories stated there. And this one has been considered as the irrelevant ones. Yeah. So these are the 3 main ones: producer, swap dealers, managed money. Now let's look at the contracts, because there's a long, short, spreading, long, short, spreading. If you want to know who controls the market, this is where you should be. The CoT report, this is where you should look at. And essentially, now let's clear everything. Yeah, essentially, look at the open interest. Open interest is 579,000. Yeah, 862. So open interest, essentially, by definition, let's not look into that for now, but I will show you where you will see it. Positions, all right, positions, 23k, 84k, 62. Yeah, you might get a bit lost in the numbers here, so remember your focus is on open interest. Now what you're going to look at is not positions, not the changes, percent of open interest represented by each category of trader, the percentage of open interest. This is now what's going to tell you who has the biggest share in the gold futures market, because whoever has the biggest share is the one who's going to influence the direction of price action in of that futures contract. And here we can see 4.1, 14.5, 10.8, 53.7. Let's circle that. 4.1, 37.3, 5.5, 5.4. This is 23. Yeah, 23, 5.7, 6.0. So essentially you can see there is one number here that's standing out a bit too much. This is 53.7. Yeah, percent of open interest represented by each category of trader. If there is one category of trader carrying over 50%, right? Of course, you can see this is the highest reading among all these ones. So this is supposed to tell you this is where the money is, all right? This is where the money is, guys. Don't confuse yourself with whatever funny stories you have. No, this is the actual data, and this is where the money is. Now you can go up and look which category is this. So this is swap dealers, and not just swap dealers. This is long, short. So this is category of swap dealers short. In fact, if you just draw a line here, you can see long, short, spreading. Short contracts, there were so many, 300,000. If you look at these other contracts, there is no other position where you have such a large volume of contracts. And if you go to the percent of open interest represented, it's 53%, right? Meaning most of these positions, they are very much open, and this is where most of the deals are. Most of the unsettled deals are short positions by the swap dealers, and you can see how many contracts these are. So this is supposed to tell you that big money, or rather most of the money, is betting against the price of these futures contracts, and the futures contracts in question here is gold, right? So this is supposed to tell you as of July 16th, 2024, most of the money in the futures contracts of gold was actually in short positions, right? Simple. That's it. If you look at number of traders in each category, 9, 17, 19, 20, 28, 11, 111, this is not going to help you. What's going to help you the most is percent of open interest represented by each category. Because the one who has the highest percentage is the one who is controlling the market. Like these positions is the one that's going to heavily impact the direction of the market. So now we have seen most of these guys were actually short, right? Now let's end this one there. There's something else we're going to look at, and let me show you. This is our website now, right? This is this has been the CFTC website, the official one. So there are many other websites where you can find this data simplified, and I'll show you to one of them. This is bar charts. Yeah, bar charts. If you go to bar chart, in fact, let's go to home. Let's just start from home. Barchart.com. Once you get to the website, this is what you will see. All right, and this is, let's do this here. Yeah, this is what you'll see, and this is the best websites from my experience to look at these COT positions, because yeah, there's something else I will talk about. So futures, go to futures. Let's zoom in. Yeah, under the tab of futures, this is where you'll find commitment of traders. You can see this is where it is. Commitment of traders. So you're going to go commitment of traders, legacy report, disaggregated report, financial TFF report. Remember, even just to state in the website, the legacy report and the disaggregated report are usually the major ones, right? So you can just, let's just start here, commitment of traders. So commitment of traders reports provide a breakdown of each Tuesday's open interest for markets in which 20 or more traders hold positions equal to or above reporting levels. This is the definition provided in the CFTC. I believe you have read that too. And yeah, so Burchard recently added the commitment of traders index study, which plots the commercial large traders and numbers in relation to longer term range. So this one, we're going to come to it shortly. But now, for now, let's just look at the COT reports themselves. So yeah, disaggregated reports chart. So grains, energies, metal, livestock, dairy, softs. So you can see these are all agricultural products, agricultural energies, and metals, precious metals. Right? These ones are only recorded via a disaggregated report. They do not exist in the legacy report format. No, they don't. They only exist in the disaggregated report format, which is divided into those three main categories. I'm sure you remember: producers, swap dealers, and managed money. Right now, there is the financial traders reports. Now, these financial traders report, this is where the legacy reports are. And you can see currencies, financials, and indices. They are under this financial traders reports, but this is usually what's called the legacy reports. All right. So yeah, there's some notes here about the open interest. Remember, I said if you don't know what open interest is, I'll show you somewhere where you can get that info. Yeah. As you can see here, all the info is here. Open interest. This is the total of all futures and or options contracts entered into and not yet offset by transactions. All right, not yet offset by a transaction, by delivery, by exercise, etc. So the aggregate of all long open interest is equal to the aggregate of all short open interest. All right. So essentially, it's all positions as a combined total. Open interest, total of all futures and or option contracts that are not yet settled. Right. These are open positions in general, open interest, open positions in general that have not yet been settled. All right. Or rather, what do you call it? Pending positions that have not yet been settled. Okay, so you can read this for yourself when you're free time, and then there's the reportable positions, commercial, non-commercial traders, and yeah, what else? What else? There's something I'm looking for. Yeah, the disaggregated commitment of traders report. You can see there are specific notes about this specific type of CoT reports, covering only the major physical commodity markets. All right, disaggregated. They all cover major physical commodity markets, like we've just seen. Majorly agricultural products, oil and petroleum products, and energy products, and metals. Increases transparency from the legacy COT reports by separating traders into the following four categories of traders: producers, swap dealers, managed money, other reportables. Right? The legacy COT reports separates reportable traders only into commercial and non-commercial categories. Producer. Now these are definite definition of these categories. Producers. Is an entity predominantly engages in the production, processing, packaging, or handling of physical commodity and uses the futures market to manage or hedge risks associated with those activities. If you remember, still in this channel, there's a video I did just very recently talking about the various types of contracts in these financial markets and essentially why they exist. And remember, futures contracts used by these producers are mainly used for hedging. All right. If you are dealing in gold, if you are dealing in cotton, if you are dealing in soybeans, if you are dealing in oil, if you are dealing in petroleum, if you are dealing in wheat, all these physical commodities, you have to hedge against your physical commodity such that in case prices fall, your books can still balance. Your books can still balance in that if you're going to sell your wheat or whatever, if you're going to sell your physical commodity for cheaper than you projected, you are going to have a smaller loss because you had a futures contract against that physical commodity. Right? If you don't understand that, just go and watch that video. Everything will make sense about why these producers are in the market. All right, swap dealer. A swap dealer is an entity that deals primarily in swaps for a commodity and uses the futures market to manage or hedge the risk associated with those swaps transactions, right? The swaps dealers' counterparties may be speculative traders like hedge funds or traditional commercial clients that are managing risk arising from their dealings in the physical commodity. All right, so as you can see, the producers here and the swap dealers, they are kind of like in the same category since the swap dealer is serving, but the swap dealer here is serving both speculative traders like hedge funds or traditional commercial clients who are managing risk from their dealings in the physical commodity. This is like an intermediary, all right? And these are the guys who now place positions on behalf of either of the two categories. Okay, managed money. A money manager, for the purpose of this report, is a registered commodity trading advisor, a registered commodity pool operator, or an unregistered fund identified by CFTC. These traders are engaged in managing and conducting organized futures trading on behalf of clients. All right. And then other reportables. Commitment of traders, futures, financial report. No, we're not going to look at this one. Essentially, now you get the gist of what's really happening with this COT report. And still, from this page, from this website, remember I talked about now the commitment of traders index. I believe we can look at this. Yeah, now we can look at this before we continue. So yeah, this is it. Commitment of traders index. Now there's an index for the COT. Index indicator type, these are standalone for interactive charts only. This, remember this index, now you're going to see it here in the definition. The commitment of traders index is a method used to quickly quantify actions of a group of traders, all right? In the case of the commercials, the COT index allows us to put into perspective the weekly positions of commercial traders so that we have a consistent reference point by which to judge their actions. By doing this, primarily the primary underlying for the budget study is the default COT commercials report. All right, you're going to look at that. By doing this, you can determine very quickly how the current level of buying and selling compares to any previous time in the past 3 years, as is the case in traditional COT index or over the amount of history specified in the study parameters. By knowing this, we can look to replicate the conditions in which any market previously rallied or declined. Blah, blah, blah. Essentially, an index will range from 0 to 100, right? And will give us the percentage of bullishness each group of traders are in a particular market, with a reading of 100% indicating they are at their most bullish in the last 3 years, and a reading of 0% indicating that they are at their least bullish or they are most bearish in the last 3 years. All right. An index is calculated. Okay. Let me give you a summary of how an index works. It's from 0 to 100, right? If it's above 50, it means um, it's essentially at a net long, or rather, the market participants are now more bullish than they are bearish on the price of that underlying asset. If the index is below 50, it's supposed to mean that the commercials are more bearish than they are bullish about of on the price of that specific underlying physical commodity. So like here, for example, this is 999, meaning they are at their most bullish level in 3 years. This is an index, right? It's going to be useful in the next few steps I'm going to talk about, but yeah, just keep that in mind. Okay, now let's go back to here because yeah, this is where we are. Disaggregated report charts. Now we can look at the reports themselves. Now let's go to gold because this is the focus of today. You can see this is a chart. This is a chart now of these reports, but let me go to a more refined one. This is not going to be so. Yeah, you can from here go to futures and then legacy report or disaggregated report. You can choose whichever one you want, but since we have seen where gold is, let's go to disaggregated reports so we can see the summary, right? Full list, disaggregated commitment of traders net positions, full list. Energies, grain, livestock, metals. You can just go to metals and then yeah, gold. You can see this the first one here. So for producer, merchant, processor, user, these are their positions, all right? And this is a detailed report. You can just choose a summary report or a detailed report. This is the summary. These are net positions, net change, long change, short positions change. This is summary. But as we have seen from the CFTC website, the biggest among these three was the swap dealers. This is where most of the positions were. Yeah, and you can see that here. Let's go to detailed report because that's the one I prefer. So you can see commodity gold 52-week high, 52-week low, 72,000 net short, 52-week low, 248,000. And currently we are at the lowest point because these are the most bearish. If you look at all these other numbers going backwards, none of them is in the 248k range. All of them are below that. So this is the most bearish commercials, not commercial, but rather swap dealers are at the current prices, or rather the current prices at that time, July 16th. If you look at now the other one, managed money, you can see, yeah, the position is the same. Remember. In fact, let's just go back and keep it open. This was short format, metals and other, silver, gold. Yeah, this is the one. Let's put this here. Remember, we're looking at percent of open interest represented by each category of trader. You just look where the money is, and this is the biggest position essentially. It's with the swap dealers and it's with the short positions. It's usually just with the swap dealers, all right? And now going back here, yeah, you can see the swap dealers. This is where most of the positions are. This is the net positions, all right? If you go to this summary report, that's why I'm going to see short positions, yeah, 311,000. And if you go back to CFTC website, you can see 311,000. Yeah, gold net positions short by swap dealers. Yeah. So this is the summary. Okay, or rather, this is the better refined version of what you have seen there on the CFTC website. Now looking at this net position in a 52-week range, yeah, this is what's going to tell you who is buying, who is selling, all right? Or rather, is the market going to follow which direction, right? And if you see a case like this is the most bearish that this group has been in the last 52 weeks, and that's supposed to tell you the sales are in control, the sellers are in control, all right? And that's what's going to be reflected in the price action. If you look at this and see net position 52-week range, 400 and no, rather 4,761, the most bullish, and yeah, this is what's going to be reflected in the charts. This is now palladium. Remember, this is this one applies mostly to commodities and physical underlying assets. If you try to do this with currencies, you might be very wrong, because currencies, even there are no swap, there are no producers, there are no merchants, there are no processors and swap dealers in the currency market. No, in the currency market, there's a uh, different set of market participants whose positions may not be as clearly defined as you're seeing, or rather as you will see in this category of physical commodities. All right. So yeah, that's it. Now we're going to look at the CoT index. All right. Even before we go there, let's just now look at the legacy report. This has been the disaggregated report. You go to the legacy report. There's something I'm looking for. Yeah. Still in the legacy report, now you can see this is where everything is: currencies, energy, financial, grains, indices, livestock, metals, softs. So going now to metals here, remember, just as it has been stated in the website, the legacy commitment reports are usually classified by exchange. But now what's here in this website is the combined positions of these contracts from all the exchanges combined. All right. So now if you see gold here, for example, this is now showing, let's go to summary reports. Yeah, if you see gold here in position, in, for example, this showing net positions in gold minus the 9k, and yeah, this is where the net positions are. It's net bearish. If you again go to non-commercial large speculators, these guys are net bullish. All right. And like we have seen from the disaggregated reports, which is where think the open interest is listed, like from the disaggregated report, you can see here money is with the swap dealers and what do you call them, the short guys, percent of open interest presented. This is where the money is. And if you go now, you what you're supposed to do here is to look at the number of contracts. Where are the most contracts located? All right, and you can see this producer merchant swap dealers. This is where most of the contracts are. If you look at this one, there are not that many contracts as compared to these other ones. All right, so back to here. Now, you're not going to look at non-commercials because these are speculators. All right, these are trend followers. These are people who follow the money. They do not dictate where the market will go. No, them they don't dictate where the market will go. Them they just, because their positions, as you have seen, they're not that big. They only follow the trend. All right, there's a specific group of traders who now their positions are the ones that say or rather dictate where price action will go to. And like you have seen, it's there. What do you call them? What are those guys? The swap dealers. Okay, so now here you can see there are only two categories. They are not three like in the disaggregated report. That's essentially what's happening is that producers and swap dealers are usually combined in the commercial part, right? And you can just know this by looking at their positions, because the total of these positions, whether commercial and non-commercial combined, is supposed to be the same total as the positions here. The positions, these are the same numbers. It's just that the numbers here have been divided into commercials and non-commercials only. If you look at now, let's look at the detailed report. Detailed report. This is where the positions are. This is where most of the positions are, and this is where the direction of the market will go to, because this is where the most of the positions are. Now look at the CoT report. Essentially, what you're supposed to do is you just click to see the futures prices, and then you can choose whichever contract. By the way, just choose this first one, for example. Just choose this first one, and then full chart. Open the full chart, set the chart to why is it so slow? Bar chart. I like this bar chart. Just put this to this side. Bar chart, and then plus study CoT. You can actually overlay the positions of the commitment of traders on these charts. All right, so first, before we go to the CoT index, let's look at the CoT disaggregated, because like we have seen, that's where the money is. Other reportables, no, we don't want to look at that, because we've seen these are insignificant numbers. All right, and then there's the producers, swap dealers, manage money. Remember, the highest position, the highest number of positions are with the swap dealers. So keep that in mind. Now I don't want to add this to a new pane. I want to add this to the main window. Add. Yep, this is how it looks like. If we just zoom out, I think it becomes a bit more. Let's also zoom out this page. So now you can see there are three main lines on the chart. Unfortunately it's a step chart. It's not smooth or curved or like linear. No, it's a step chart. That's why you're seeing it's like stairs. That's what step chart is. So these are the positions. Remember, just like it has been showed in the colors here, swap dealers, it's the green one, manage money, purple, producers, red. So these are producers, these are the managed money, and these are the swap dealers. And as you can see, let's try to now hide some of them. Let's hide the producers. and let's the swap dealers for a bit. Apply. So now you can see the swap dealers essentially, these are no, not swap dealers, these are managed money, all right? Managed money. These are what you guys consider, some of you call them the big banks or the hedge funds or whatever conspiracy theory you believe in. So you can see these guys, these managed money guys, these are trend followers because they are most bullish at the top. You can see this is the number of positions now. These guys are most bullish at the top, and when the price is falling, they are falling with the price, and when the price is at the lowest, they are the most bearish. Essentially, this is like looking at the same chart, all right? So this is not going to help you in trying to determine where the market is going to go to, because if the same people are buying at the top, or like most bullish at the top, even when it comes to here, you're not going to know which direction price action is going to take. So that's essentially why it's advisable to just ignore this one. Now let's go back here and look at the swap dealers alone. Let's look at swap dealers alone. For today, I won't look at producers, but let's just focus on the swap dealers because you have seen that's where most of the positions are. Yeah, swap dealers. Now, what are we seeing here? This is now a very interesting pattern, and this is, in my opinion, what you should be looking at if at all you are genuinely interested in rather in trying to know where the market direction will go. All right. So remember, as you can see from the scale here, these are net short. All right. These guys are always net short, because remember how this works is hedging. This is mostly hedging, and when you're hedging, you bet against the physical commodity, so that when the physical commodity value of the physical commodity drops, you are going to make a profit on your futures positions in the market to offset the loss you have made on the physical commodity. All right. So as you can see here from this chart, and this line is that this line is mostly doing the opposite of what price is doing. All right. They are most bearish when price is forming a peak. All right. And they are most bullish when price is forming a trough. When price is at its lowest, that's when these guys are bearish, least bearish or most bullish. Yeah. And moving on, as you can see, they diverge. This is how this one works. They diverge, and essentially, as it is low now, if you just come here and see, anytime price is this low, it means anytime their positions are bearish to this extent, it usually means that price is about to see a retracement, or rather usually a significant one. And that's what's most likely to happen, because as you have seen, their positions are the ones that actually affect market directions. All right. Like here, these guys were extremely bearish at the top. This is 2022, March 2022. This is when gold was forming a new high. This is around this is the time gold broke past 2000 in 2022. And you can see at this high, these guys were extremely bearish, and price followed that bearishness. And as price continued falling, they continued to reduce their short positions, and at some point they were no longer reducing their short positions, and now price started to pick up again. Yeah. So essentially, if you don't understand that, you'll just have to read and what is it? You just have to listen and re-listen, or rather just go read for yourself until your mind can open up and see the logic here. All right, so now we're going to look at the CoT index. The CoT index, now remember, an index is something with a time frame, all right? So let's go here, plus study. CoT index. So an index is something with a time frame, all right? If you want to look an index for 3 years, like how managed money has positioned themselves, or rather commercials, because remember the commitment of traders index is for commercials, all right? Mm, hmm. In the case of commercials, the CoT index, yeah, this is the CoT index is usually for commercials. And remember, like we have mentioned, wait, kwani umepotea? Yeah, remember, like we have mentioned in these CoT reports, producer, merchant, processor, user, swap, dealers, manage money. Under gold, swap dealers are contained in the commercials. Yeah, their positions are recorded. Most of them are recorded there under the commercials category. Some are recorded under non-commercials, but most of these positions are under the commercials category. So that's why the CoT index of the commercials becomes important to look at. And now you can choose a time window. Since we are looking at a trend from around 2022, between 2022 and now, that's around 3 years. Yeah. Now you can CoT index line, new pen. Let's add it to the on top of the chart. All right. Yeah. And you can see. Essentially, remember from the basic definition, what this index does is that anytime it's 100, it means most bullish. All right. Like these guys are buying like crazy. All right. And anytime it's at zero, it means these guys are selling like nonsense. All right. These guys are extremely bearish at price when the index is this low. Right. And you can see it's the opposite of what price action is doing, meaning it's the leading one. Because for example here, if these guys are increasingly, or rather, let's look at when was that? Yeah, 2022. Yeah, we were talking about 2022. Yeah, this is around March. Because if these guys are increasingly being bearish on price at these levels, this means that something big, huge sell-off is coming. And you can see to that, the index dropped from around 56 to 26, meaning almost half of the positions they just increased net short positions. And true to that, during this time frame they increased their net short positions as price was going up, and shortly afterwards, this because this is a span of just 1 month, in the next month prices started falling and they fell continuously for uh, yeah, this is around the rest of the year for the next 2 quarters, until at another point now when the index was, or rather price was forming a bottom, and the index here, these guys were starting to become extremely bullish on price at this level. All right. So, and then price picked up, and essentially it's mostly that negative correlation between these two. So, now how to interpret this index in the right way, or rather, for it to help you, you need to look at the extreme zones. All right, the extreme zones. For example, now, yeah. So what you want to be focusing on is the extremes. For example, now that we are at zero, completely zero flat, it means these guys are the most bearish they have been on gold over the past 3 years. And yeah, because yeah, the index is for 3 years. And if you now still go a bit lower, like on a, what do you call it, on a 2 years 1 year basis, apply 1 year, apply, yeah, essentially now you can see the fluctuations are a bit more clearer, since it's showing a range of 1 year how these guys are positioning themselves. You can see there was another time here when the index was almost at zero, but it was never at completely zero. No. So what you're going to look at here, for example, the index here in early, what is it? February. Yeah. Early this year in February, the index was almost getting to 55, which is the most bullish these guys had been on a yearly basis. All right. And true to that, this is when the market formed a nice bottom, and this is actually the last time gold was under 2000. So it's like these guys saw it coming because their bullish positions, rather not their bullish positions, but rather their nets. Yeah, actually it was nets bullish at this point. So yeah, price ended up picking up following these this trend. Now price is picking up, and now from here they started reducing their long positions. They started increasing on the short positions as they became more and more net short until now where we are, that these guys are just extremely bearish on the gold price at this level. And now going a bit lower, to look at rather on a weekly basis now, because this like we you have seen in the definition, these positions are only as of Tuesday of every week. And on Tuesday here, like you have seen in the positioning, the number of the weekly change in number of short positions increased by hmm, let's go to legacy reports, and then metals, and then wanted to look at gold. Yeah, this is the one we wanted to look at. Yeah, let's not look at the chart, but rather the positioning. Yeah, and then as you can see here, the net positions by commercial, these are the large hedgers, increased by over 20,000, which is a significant increase because even in the previous week they had increased quite a lot. And yeah, that's essentially, if you go to the summary report, you're going to see the change in short positions was, yeah, quite significant here. And even, yeah, this range essentially shows these guys are the most bearish they have been in a year. And that is what was reflected in the price action. So essentially, for you to know if the gold price is going to continue falling, this index is going to stay at zero, right? Because yeah, we are currently at zero. This index is going to keep to stay at zero, and that's going to indicate that it's very likely that the price will continue falling. Once you see the index start picking up probably to around 5 to around 10, it means these guys are reducing their short positions and increasing on their long positions, and that's supposed to mean that price will start picking up from there. All right, price, yeah. So that's it for this video. That's what I intended to show you, and that's it. If you go to, as you can see, all along I have been using the daily chart. All right, this is something you use on a macro scale. You don't because even as I am using the daily chart, I'm only looking at price swings between several weeks. All right, between several days. This is around 3 weeks, right? Yeah. So this is something that's going to help you have a long term, not necessarily long term, but rather in the near term, foreseeable future. This is something that's going to really help you see where price is going just by following the money. All right. Remember, this is the index. All right. If you seem to be a bit more confused about the index, you can just go to the CoT report itself, and If this is the one you understand better, well and good, because the main piece of information here is looking at the percent of open interest. All right, look where the biggest number is, and not just biggest number, but rather biggest number by far. You can see this 53. The closest to 53 is 37, meaning a lot of positions are in the short category here, right? Yeah. So that's it for this video. If you found it helpful, you can let me know. If you think there's something I should have talked about, you can let me know in the comments and I will definitely look into it. All right. Have a good day.